I'm Owen Bigland. This is the Inside Edge video blog. As promised, I just got back from my annual trip to New York City. As people know, I've been watching my blog here for a while. You know, every year in the fall, I get invited to an investor summit through a good friend of mine who's in the private equity wealth management business in Manhattan. And every year I go out, it's a 2-day event. I rub shoulders with some of this firm's high net worth clients, and I listen to a variety of speakers on some of their ideas, where they see the markets going. They talk a little bit about real estate. They also talk a fair bit about the investor mindset that this company's philosophy has always been based on. They're really the type of assets that this company invests in for their high net worth clients. They invest in real estate, but they also invest in a lot of blue chip companies like Apple, Johnson & Johnson, Procter & Gamble. They're really value and buy and hold investors. So I always come away with pretty reinvigorated after I get back from my 1-week trip to New York. And I'll do a couple of blogs on this, on some of my takeaways. But first up, with some of the things that were talked about at this year's summit, and it's always kind of reoccurring themes about the investor mindset you need to have, and patience, and staying the course. And on this one, they talked about keeping your eye on the big picture. And there was an interesting speaker who talked about how, things like social media and Twitter and Instagram and all these different investment blogs are really starting to confuse a lot of investors. And I couldn't agree more. There's that old statistic, I think it was Warren Buffett or Peter Lynch, that said if you spend 15 minutes analyzing statistics and predictions and analysis, then you probably just wasted 13 minutes. So, sure, read some of these things, take in the information, but I think it's overkill in a lot of cases. If you buy good quality companies, monitor them, or buy good quality Vancouver real estate and hold it, let time do the heavy lifting for you. There's also that old analogy that one of the guys talked about. Think of your investment portfolio, whether that's real estate or whether that's a stock portfolio. Think of it like a bar of soap. The more you handle it, the smaller it gets. So buy it and leave it. And I've been stressing that for years on my blog here, about here I am as a listing realtor, meaning that 80% of my work is selling and marketing homes for my clients. And I'm under the belief that if you can, there's lots of good reasons to sell and why my clients want to sell a home, and I'm happy to step in and become their realtor for it. But if you can, my advice to most people is just try and hang on to the property. Keep it, let time do its thing, put a tenant in there and let them pay down your mortgage. It really goes against how I make my living. Because I make my living selling homes, and I'm telling you to hang on to them if you can. But a couple takeaways is keep your eye on the big picture. And again, so many people, especially I see it on my YouTube channel here and some of the comments I get, they're so wrapped up in what's going on short term in the market. Like some guys, putting in comments about, I think they're going to crack down on money laundering and that's going to crash the entire market, and investors are going to get out, and you're not going to be able to bring capital in from outside the country anymore. I don't know whether that's going to happen or not, or if it's going to have any effect at all on the market, but I'm sure not going to lose any sleep over it. I'm going to focus on the things I can control. And that's, if you're watching my blog here, that's earning a living, making money, saving your money, and finding ways to get your money to work for you. And the two best are through real estate and buying good Canadian and good US dividend paying stocks. Don't get caught up in all the static and all the noise that is out there. And we were talking, and this guy, one speaker, had talked about how it might have been a lot easier 15 or 20 years ago to be an investor. And I would probably agree with him. When I first started buying stocks 25 years ago, I used to have to rely on the Wall Street Journal that I would buy. I'd buy some investing magazines, and then every quarter, the brokerage that I was using at that point would give me their quarterly report and analysis book on the various companies they followed. And you'd make your order by phone. You'd call it in. You'd pay $99 for the transaction, which was expensive. So you were more inclined to buy a stock, hold it, and you weren't bombarded with all this news on the stock. Today, of course, it's the reverse. We're absolutely bombarded with information nonstop. And if you've bought my book, you'll know that the price fluctuations you see on, let's say, a stock like Johnson & Johnson day to day, oftentimes those price movements have very little or nothing to do with the stock itself or the company. It's just trading in and out by large institutional investors. Oftentimes people will think, well, why is my shares in Johnson & Johnson gone down $2? Something must be wrong with the company, when there isn't. Oftentimes what's happening is that a large institutional investor has redemptions from clients or sees a better opportunity than Johnson & Johnson that they want to put money into. They have to sell something, so I'm going to unload 100,000 shares of J&J and move it into this other stock. They can be excellent buying opportunities as well. So the big takeaway here is keep an eye on the big picture here. Don't get bombarded with all these statistics and numbers. As I blogged about many times here, you know, if your priority number one, if you're watching here and you're a young person, is to buy your principal residence, that should be your first step. I go into detail on it on my book. One of the main reasons is that there is no alternative to owning a home. You're either going to own your principal residence and build up capital gains tax-free, or you're going to rent. You can't live in your car or live in a tent on the street here, or what do they call it, urban camping. It's not going to be an alternative. You're either going to own your home or you're going to pay $25,000 to $30,000 a year to rent a one-bedroom in Yaletown. So over the next 8 years, with rent increases, you're going to spend easily $200,000 to $250,000 on rent, which you're not going to get anything back for. The alternative would be to save that down payment money, get that down payment together, which is the hardest part. Once you've got the $50,000, $60,000, $70,000 down, you'll see that your mortgage payments, your property taxes, and your maintenance fees are going to be about the same as what you were paying for rent. So that should be your first step. And of course, the capital gains exemption is massive. It's created and minted more millionaires in this country than anything else. So I'm going to do a few more blogs over the next few months as well on a few other things that I picked up in New York that I think you guys might enjoy as well. I'm Owen Bigland. Thanks for watching. See you next week.